All right. Hi, everyone. I want to talk to you in a different manner. I'm a buy-side retired professional, and I believe that you can learn from the buy-side and the professional side. Most of what you hear is retail traders and small funds managers talking to you. And what I want to do is introduce you to the other side of the market that is hidden from you. So I want you to think like an institution, which sounds crazy, but it isn't. The market structure that guides real buy and sell decisions by the professionals of the market. As always, we are an educational company. Always. We are not recommending any stocks. We are not doing anything like that. So please be aware that it is education only and that everything is copyrighted. Uh, I am a chartered market condition technician, and I've been so for many, many years. I'm a longtime member of the CMT Association and approved with the SEC Series 86. And you go, who cares? Well, it is important because everyone on the professional side is licensed. The SEC licensed different people for different things. I'm licensed as a cycle theorist, as a technical analyst, and that type of thing, and as an educator. I've been the CEO and co-founder of TechniTrader with Howard Johnson. We have been teaching for 27 plus years of educating professionals, semi-professionals, and retail traders. And we have an A plus better business rating, which is unparalleled. Nobody has 27 years of A plus better business rating. So we are very sincere and honest. And that's important. The SEC, I get reports from the SEC every day, and they're telling us more and more and more scams and karnas coming along because people are in a state of flux and uncertainty. I am the author of Cycle Evolution Theory, How to Identify Evolutionary Cycle Deviations, which totally turned the cycle theory theorists all across the world upside down because suddenly, instead of trying to prove that a cycle exists, I said, wait a minute, cycles deviate, cycles evolve, cycles change. They have extreme deviations, extreme troughs. Things change, and when they're changing, something is happening in the market. That's a very foundational structure by which the buy-side institutions determine what stocks they're going to buy. And I also have relational technical analysis, which is the advanced version of what you have as technical analysis. And everything you've learned so far is very useful. What I'm trying to do is for those of you who really want to move forward, then you want to use relational technical analysis, which asks the question, who is in control of price? Because it isn't Main Street versus Wall Street anymore. And I'll show you why. The inner market structure has changed dynamically since 2022 when AI was first being developed and analyzed and used, and nobody in the retail side really even knew it existed yet. The stock markets of the world are in massive evolutionary change due to AI. It is imperative that you keep up with these changes, and you are not if you only learn the retail side. However, many of the indicators, trading tools, and strategies you are using are now outdated and obsolete. In order for you to succeed in the new global financial markets, you must understand these changes and how they impact how you should trade. Those changes continue to cause many older indicators, strategies, and trading systems to be obsolete. So you need to update what you're doing. What you had in the past was great, but things have changed. So let's look at NVDA. I just popped this into my program web PowerPoint this morning, and we can see a lot of things. So when I look at this chart, I see a lot of information. When you look at this chart, what do you see? You see a stock that has been moving sideways since early September or late August, actually. But what I see is a buy-side buy zone. They've been steadily accumulating this stock. And we can see it in some of the indicators and things off and on. Their action is very subtle because they have a time-weighted at average price automated system that once they have quantitatively analyzed a company and what it's going to do and forecasting for the next year or two, they start whether accumulating or distributing or rotating out is what they mostly do nowadays. So this impacts ETFs, this impacts all kinds of things. but they are in this stock and they are holding it steady. And it's even moving up while we have all this craziness in the world right now that's probably terrifying everybody. This stock is being accumulated. So, what does that tell you? The buy side knows something that the rest of us, you, retail siders, don't know. Professional stock trading. Professionals are not worried right now. They are busy making higher profits with less work. At market open, they are already making profits. They trade on the millisecond. So all your orders are let by your broker. It's required by the SEC law, so the broker can't cheat you. And then he can shove them. The broker no longer carries inventory. They can't afford to because they give you your trading for free, but they're a business. So how can they make any money? So they sell your orders to the payment for order flow market makers, and those are new market makers that take all the order flow from the retail brokers and they fill the orders on the millisecond. So while you're typing it in, they already know what's going on. And when there's cluster orders and things, which I'll talk about later, that's even worse. Most retail traders are chasing runs after a huge gap up and losing money. Why? Because you go out and you join a chat group or you join a social media or you listen to some small funds managers who have less than 5 billion assets under management, which means they are retail, they are not professionals by the SEC. And so you listen to them and you say, oh, this stock is recommended, I'm going to go buy it. Yeah, you can't do that. What do the professional traders know that you do not? How can you trade like a professional trader who makes 6 to 7-digit incomes annually easily, and they're not working as hard as you are? You're working really hard. This is the kind of thing that they're looking at. This is the common layout. It's really big, but they are analyzing everything and they're doing it. They do not use AI. It is forbidden to use AI as a automated trading system, okay? The only thing they can use it for is routing, or if they set up like a TWAP with an automated system that pings, but they're not using it there. Dark pools are not using AI at all, except for quantitative analysis of a company's records over time. It is not guru recommendations or complex formulas that you need to learn. It is about understanding the dynamics of the professional side of the market. So this is NVIDIA on 1 minute. And I know a lot of people are really gung-ho for intraday trading, but it has almost no value because this was live this morning. And I put some things in because you can see that there's penny spreads and they're very volatile. Also, you will notice that a lot of times there is low liquidity. Right now, at the time I took this, very low liquidity, which can cause big gap downs and run downs and volatility during the day. But it is a very volatile market on the intraday, so you need to be careful. The only times that you might want to look at the end of day data or before the market opens, you're going to see a huge gap down on futures, but that doesn't mean the stock is or the market is going to continue that way for the rest of the day. I'll show you that later. So the bull market of cycle participants has buy-side institutions and dark pools. It doesn't matter if this is 1 day, a week, a month, a year. This is a cycle that happens all the time. They get into bargain price stocks that they have determined by their quantitative analysis that are going to have strong growth in the next few quarters or year. And so they start accumulating. They're long-term investors. They are the fiduciary responsible parties for taking care of the massive wealth of the middle class of America, which is the largest middle class in the world. Not even China has that. And the wealthiest. They're taking care of hundreds of trillions of dollars worldwide. Wealthy private investors are usually your gentlemen who were CEOs, and they know all about business because the stock market is the business of businesses. So they have money managers and they tell the money managers what to buy. Sell-side institutions have a floor. They are short-term traders only by rules and regulations of the SEC. So they are selling short-term. Sometimes they are market making. Sometimes they are doing buybacks on behalf of the corporations. We have 486 of the 500 S&P 500 who have open buybacks right now. So corporations are helping boost this market and holding it up because it's holding up. It's not crashing. And then we have professional traders on the buy side who adjust the portfolios for our ROI, our return on investment potential. And we also have professional traders and independent traders and companies. Now, these companies either work independently or individuals work independently, but also they can sell if the institutions want their ROI to improve, and it can't be done from their traders base who are long term, just adjusting ETFs and portfolios subtly. They will go and have them do the work, and then that boosts the ROI for 401ks, IRAs, and so on and so forth. So it's all working together. Corporations will do buybacks, but the sell side does that for them. They also invest in, right now, the biggest investments the corporations have been making in the last 6 to 8 months and will be concluding soon is infrastructure, physical infrastructure worldwide. They've been doing physical structure under development worldwide for the past 5 to 6 years. During the pandemic, they started. High frequency trading and hedge funds actually trade on the retail side, but they are professionals. HFTs trade on the millisecond. They front run. They are most active at the market open, causing things to gap down and run down stocks and so on and so forth. Hedge funds are similar, but they also have a floor of traders, and the traders are doing the decision making. HFT is the only place where AI is making the decisions. And this last earnings season, it made a huge amount of mistakes. 80% of all the market activity, some $350 to $400 billion, changes hands every day on the market. Did you know that? So your 100 lot or 1,000 lot order is small. These groups get in after this, and they're independents or small asset managers. They don't know what they're doing. They're mostly salespeople, and they're just running a small, less than 5 billion assets under management. And right now, the buy-side institutions are selling a huge amount of these. They think they're going to go under because they're getting redemption demands. Sovereign funds and foreign funds. Everybody trades our markets. Everybody trades our markets. So because we have all the stocks, we have 1,000 Fortune companies, and all the other 220 some odd stock markets only have a few big name companies. So everybody trades our market. Memes groups, retail traders, they get in very late in the run. Oh, it's moving. Now I should get in. They get in around lunchtime. Small lot investors get in very late. They buy on the dip. And then retail trading groups get in very late because they're waiting for something to recommend or somebody decide what they should trade. So they're in very late. And odd lot investors get in because the stock will not go down. I got somebody saying today, copper, oh, it looks like it's never going to go down. It's like, okay, don't buy it because it's going to go down. 20% of the market, all market activity is retail. So you want to learn this, and we're going to focus on buy-side institutions today and professional traders. This is the inverse. Dark pools start the rounding of the by rotating out, and then all these other companies follow. And you are always getting in very late. You decide to sell when the buy-side institutions are starting to form the bottom. The buy-side institutions always form all bottoms. Write it down. Impact of dark pool activity for the financial markets. Alternative trading system venues, also known as dark pools of liquidity, have been around now for over 23 years. It's nothing new. Dark pools manage the vast wealth of the U.S. middle class, and they do it seriously because that's where they make their money. The fees that manage the 401ks and IRAs and all the other pension funds from 1,000 giant corporations and thousands of mid-sized corporations. ATS are the peer-to-peer OTC, over-the-counter transaction that eliminates front-running of giant lot orders. It used to be in the 90s, you could see all the large lots, and they used to be 1,000, 200,000, 500,000 share lots, and you could be in your level 2 or level 3, and you can see, oh, wow, we can front run these. That it doesn't exist anymore because these dark pools are not there. So HFTs evolved as the market shifted from fractions to decimal pricing. HFTs, hedge funds, retail groups, and small funds managers try, but do not ever front run the pools. If somebody's telling you that they have found the dark pools, or the whales as they call them, they haven't. They've found a $5 billion small funds manager, and they are retail. They're not even near you can't get into this thing. And it is a massive amount of money. It's stunning. Hundreds of trillions. Okay. So what is this chart telling us? Look at this chart. Okay, we can see that we have an up and then a couple downs and then an up and down and up and down. But what is happening with the price? Is it going to continue to go down or is it being pushed up? And look at this, $1.95 on its earnings and $1.95 on its earnings. Hey, why did it have a HFT gap down? That's an HFT. HFT spikes. Volume, huge volume is always HFTs, always. And all this is small funds managers selling, but who's buying? Dark pools, because this stock's fundamentals are way up here, right in this middle of this zone. So it's a bargain price. So they'll let you sell it down and then they'll buy and push it up and they'll let you sell it down and they'll buy and push it up. Meanwhile, you're trying to sell or sell short against buy-side institutions who have trillions of dollars to spend. And Amazon has a huge potential for growth. They know this. I know this. I'm retired buy-side and I investigate I do a sector and industry report every year and I study all the different new technologies because new technology drives the market. New technology drives the market. And so it doesn't really matter what's going on in the rest of the world because we have 20 new technologies coming. AI is just the beginning. Buy-side institutions, also known as dark pools, the buy-side institutions are the most dominant and influential market participant group. They control vast inventories of stock in thousands of companies. They average 4,000 to 5,000 companies out of the 6,600 that are on the public right now. Trillions of assets under management. When they accumulate, the price is predetermined as in a very narrow penny strike price range. It doesn't go huge except for a certain time, and I'll tell you about that. I call these buy zones. That's my term. It can take weeks or months for the dark pools to complete their accumulation. Buy-side giants also support the market to maintain the integrity of the current trends and market conditions, and that's exactly what they're doing right now. They're supporting the market. They're targeting certain companies, and they're buying those stocks to keep the indexes from collapsing. So these dark pool buy zones can only be seen with a dark pool indicator that shows what's going on, and they have very low bars and often very low volume because they're buying slowly over time. And when they stop buying, then pro traders get in, and now you have the nice big runs that all swing traders dearly love to trade. They'll springboard and running up, and then resistance right here. So there's a lot of information that you're missing. If you're using price and time indicators and price and time oscillators, you need to switch to volume and dark pool indicators or add them to it. These are dark pool indicators that show that they stopped this rundown because at this point in April, this stock was way below its fundamental levels. And so they were able to buy and still see a bargain price into the fundamental level. Now we see that this is striking to the top of the chart. Pro traders are selling, and in the next day it goes down. So this is gives you 1 to 2 days of warning that it's time for you to sell with the pro traders. You should be trading with the pro traders as they discover the dark pool buy zones or as the dark pool buy zones create bottoms. Buy zones and sell zones in stock charts, I call the narrow ranges of horizontal trends buy zones or sell zones. If the stock moves above or below the range designated, then the dark pool TWAP or other bracketed controlled orders halt or pause. This creates a pattern that can be identified using relational technical analysis. So you want to study this. RTA includes the study of the price action, trend behavior, and hybrid leading indicators that include more data than any indicators you are using currently. This reveals hidden dark pool activity, and this is something that you always want to do. So, dark pool buy zones are they're on the charts, but they're hard to see until you're trained to train your eyes to see them. We have small funds managers dumping, but we have this huge candle upward because the fundamental level was right in here at this time when this flash crash occurred last year. So the fundamental analysis is continually evaluated by the quantitative analysis, And as dark pools complete a bottom, and this is a completed bottom, as soon as you start to see these huge candles, and they're everywhere, go look on your charts. Microsoft, PLNTR. There's all kinds of these huge, they're supporting the market because they're seeing a bargain price and they're pushing the price to the fundamental level and they stop buying. Now all of a sudden we have a higher buy zone. Why? Because they were buying the stock on a penny spread because the fundamentals have moved up to here. How do they know that? Quantitative analysis. They visit all of their companies and they send analysts out and buy-side analysts out, and the analyst sits down with the CFO and the CEO, and they look over the paperwork and they study all this stuff and they bring all this information back and they punch it in, and then they know, okay, this earnings season, this company is going to be good. It's going to be great. Then all of a sudden we have some pro traders nudges and the stock runs up. Sometimes if the pro traders nudges are strong enough, it will cause a gap up. Then we have another small buy zone with a little springboard. This is pro traders activity trying to nudge and get an HFT to get interested. Then it moves sideways again. So now over this period of time, the fundamental level has moved all the way up here. Now they stop and pause, and we have pro traders running it up and then profit taking, and that would show, it'll tell you when to get out of that stock. Then it corrects a little. Then there's more nudges pushing it up. And then there's another sideways pattern. This is not a fundamental level. This is speculated. And we have some people trying to sell it short, but it's still moving up. We have a huge candle this day, and then a good run down, which is a correction, but it's not a sell short opportunity. It's just a minor correction. And then we have a huge gap up. We have a topping pattern. So the institutions have shifted from buying the stock to slow rotation that is hidden within this framework right here. This isn't the SEC Midas. A lot of you people don't know anything about the SEC, and you should really get to know them because they're your best friend buddy. They're trying to protect you from all kinds of scams, con artists, people who would take your money and run, and they're growing in numbers. This is your penny spread of the dark pools. If it goes above, then they stop. If it drops below, they pause or they buy more. This is the dark pool buy zone. And these are thousands of transactions going on. You can see it's really active. This is retail side. All kinds of hysteria. This is what causes volatility. Do the dark pools cause volatility? No. And we have the pro traders who are trying to nudge prices up, trying to get things going. You can see how deep the green goes into this. And they're trying to nudge it up and trying to get the HFTs. HFTs are right along in here. And they are often very active as long with hedge funds. And they're often contrarian. They're hoping some retail news scares the bejabbers out of you and you start selling. And so they can do a buy to cover on their sell shorts and make a huge amount of money. Also, the sell-side institutions would be in here as well. So this is important information to understand. SEC checks this every day. And then they have the consolidated audit trail, which tells them who placed that order. So if there's a bad guy out there and they cause a big crash, the SEC knows who started that crash. Very important. May 10th, 2010, we had an enormous crash on the market, one of the first major crashes. All of the major stocks just collapsed 50%, 60%, 80%, just a major crash. It was a fundamentalist who placed a VWAP rather than a TWAP order. He was a fundamental trader on the futures for the S&P 500 and it's SPY. And when he entered all those orders on the futures market, it tumbled over and on a domino effect into the market and caused this huge crash. You can look up it on the internet. Functionality of the market since AI introduction. What do you think has changed? You get, oh, here's an AI program, and it's going to do all the work for you. It'll pick your stocks for you. It'll trade for you. You can just sit back and pour in the millions of dollars. Wrong. AI is a tool. It is new. It's going to be developing over time. It took 40 years to get it to this point. 40 years to get it to where it was in 2022. In 2014, Microsoft is going, we've got the biggest problem with AI is language. It can understand data and bits of data. It can understand numbers and it can understand because it's a program based on a foundation of computers. So it's going to be analytical in a numeric and data centric situation. So they go, well, we have to teach it language, or nobody can, the ordinary person can't tell it something to do and it won't work. So in 2014, they started having a little teeny tiny bit of success. It's now 2025 and they're still struggling to get it to language because if you've ever used AI, you have to be super specific. This is an AI image. I use AI images all the time. I love it. But if I'm not specific, it will be really weird what the Copilot gives me as far as a image. Crazy, it's weird. What actually drives the stock market to new highs is new technology. In the last year or so, it was AI. Then we had the big corporations go, wait a minute, we need to build these big data centers. And we're going to build them near the Gulf of Mexico because we have to be able to ship out and ship things, or in California, or elsewhere where there's big shipping lanes that we can do. Because every single corporation learned a really hard lesson during the pandemic. They couldn't get their supply chains in. They were using the mega supply chains that were global at that time, and everybody shipped everything back and forth. Okay, well, except for Amazon. Amazon built smaller ships. Amazon had its own supply chain. It had its own ports. It had its own docking stations. It could get into ports that nobody else could get into because it had little ships. And Amazon just went crazy during the pandemic. It was selling, it was just making a fortune. It was up to $3,000 a share. It was magnificent, brilliant, because they saw the risk way ahead of it and they made adjustments. They didn't want to be tied down to some conglomerate uh, supply chain company that has everybody else's stuff on it and getting into only huge ports. So all the corporations are building their own shipping lanes, and all the corporations have their own uh, offices, facilities, manufacturing everywhere around the world already. It's already there, but they had to build more data centers. So this is the NASDAQ 100 index chart of today. And we see that there is sort of a little bit of a rounding top here. There is some modest risk going on. But what have we got here? We have a very controlled price, value action. This is value. This is the NASDAQ 100. Today, we have very controlled activity going on. Who has the money and the power and the dominance to control the NASDAQ 100 so precisely? Who do you think? Buy side. Buy side and corporate buybacks are supporting the market. There's 486 of the 500 S&P 500 that are supporting the market. As their stock goes down, then they boost it right back up. What's a good strategy for buybacks? Swing trading. If you can recognize that a stock is in a buyback mode and it's activated because their earnings are coming up or their earnings have been over. But folks, this is a very controlled sideways trend, and we have catastrophic, scary stuff, things, real events going on right now that should have caused this market to go down, but it's persistent. Even the Dow has popped back up and moved up further. And this requires very quantitative, very analytical, and very precise entry patterns to make this pattern. Otherwise, we would have total chaos in this chart, and it would be running down steeply. Whether they can hold it or not, there's no guarantee, but they are putting their best effort forward because a lot of the NASDAQ 100 stocks that are software, semiconductor, and all the other are way below their fundamental value. It's not called oversold. They're not oversold. There's plenty of shares of stock to trade. There's always shares stock to trade. Get rid of the old ancient terminology because it misguides you. They are buying it because it's a bargain price, and that is what's boosting up. If you were to check the NASDAQ, you would see it was semiconductors in both industries and software in both industries that the buy zones show up on. So this is critical information that's in your charts that you can use to have a foundation that is going to be really good for you. It's going to make a difference. You can be a semi-professional. You can trade as a business. You can be at home trading as a business, S corporation, LLC. And what you do get to do with all that? You get to write off all of your expenses for anything and everything related to the trading as a business. It's fantastic. Why aren't you there? A lot of you are trying to realign because maybe you've been laid off, or maybe you're just trying to find supplemental income or anything. This is where it's at, folks, because this is moving. The economy may be the world may be fighting each other, there may be all kinds of mistrust, but new technology drives the stock market because it improves business revenues and earnings, and it moves itself through to the economy. And make sure your kids go to college and get a degree that is going to be there because a lot of technology is going to be gone. I wanted to show you a millisecond chart, okay, because it shows a lot of things. This is a millisecond chart, and every dot is a transaction. And then there's blocks of trades. Then there's nothing, okay? So what you're looking at are TWAP orders firing, and sometimes blocks of TWAP orders firing from the buy-side institutions, and then pauses, 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 time weighted at average price, okay? So then we have some little pro traders catching this and going, oh, let's push this up. But then, of course, all the TWAPs stop. So then it falls back down and pause, pause, pause. And then another little nudge from the pro traders, and then it starts moving up a little bit. Very exciting. Then a pause. And then a big run up. The pro traders are trying to nudge it up. They're trying to get the attention of the HFTs or hedge funds. And then it really runs up, moves down, and then it corrects a lot because it is out there taking profits. Pro traders are taking profits on the millisecond. Then all of a sudden they do another nudge, and blam, look at all of the variables that are here. Small funds managers, retail, HFTs, everybody, hedge funds, pushing this price up and up until it becomes super volatile, huge. You can't even discern the trend anymore right in here because everybody's buying at the top. Okay? Professional traders trade on the millisecond. That is 60,000 transactions in 1 second or 320,000 in 1 minute. Your orders are not filled by your broker anymore. First, your order is lit by your broker as required by SEC rules and regulations. I've stated that before. When the order is routed to the payment for order flow market makers within milliseconds. So it all happens within milliseconds. And you may get a poor fill. Even if you're using a limit order, you may be buying into a run down. Bad idea. So we can see on the chart with these indicators that something is changing in this run down. Okay? A flash crash, gap down, run down. Some buying here on the dip, smaller funds doing stupid. Sorry. And then more running down. But these candles are shrinking and things are getting less and less because the buy sides have determined that this stock is below its fundamental values. It sells gaps down one more time. This is a daily chart. And then and then the buy side institutions, it gaps down the next day, way down here, runs down, buy side institutions. And then pro traders and more buying. So do you think you should be selling short these stocks? Look at this. the buy side got out of this stock right here. Sell side institutions started selling this short, and they dropped it down to this because their buy to covers are way below their sell short orders, and they can pull the orders anytime they want, so they're not in any danger of losing any money at all. So it kind of trickles down and trickles down and trickles down and then shoots down. You got to be wary of this because this is not a good idea for you to be selling short. You need to be selling short up here, and you're selling short way down here. And it's a bad idea. So you be mindful of that. High frequency trading firms, high frequency trading systems are fully automated. The only thing in the market that is AI automated. HFTs dominate at market open mostly. HFTs use AI interpretive algorithms to pre-program orders. So they go out and they only have access to the retail side. So they go out every morning and they check on the chat rooms that you're fond of and everything public. Yeah, they're checking everything. HFTs fill the queues with thousands of small lot orders, milliseconds ahead of the market open. The computers of the market then adjust the stock price up or down based on the number of buy orders versus sell orders. If the HFTs fill the queues with sell orders, it will gap down. If the HFTs fill the queues with buy orders, it will gap up, and then it will often reverse. And this is the market open only. HFTs create the huge gaps at market open. This is why your trading orders often whipsaws or have poor fills because you're not paying attention to the HFTs. So HFTs gap or run down hugely. Common HFT and dark pool technical patterns. One of the many relational technical patterns that reveals dark pool activity is the shift of sentiment pattern where it goes from red to green. This is a combination of candlesticks and hybrid leading indicator pattern analysis. Professional traders' hybrid leading indicators expose the hidden accumulation that shifts the sentiment. Pro traders set nudges that trigger HFT algos to gap or run a stock up or down. The HFTs can't track the dark pools. They can only track you. So the professional traders can cause big gap ups. Now what's happening is a shift of sentiment here. It started over here and then it continued down, so they abandoned it. Then more smaller funds selling, and who's buying? Dark pools, because the stock is over, or it's way below its fundamental values, way below its fundamental values. So now you're fighting it, but this shift of sentiment is a very important indicator to study in relation to volume. Remember that dark pools spread it out, so their orders don't usually have really high marks. When you have really spiking volume, then you have HFTs, HFT, HFT, HFT. So you can see that they are in his all the time. Extreme price action is caused by HFTs. The shift of sentiment occurs prior to the HFT action on the upside. This identifies the buy zone because as soon as the HFTs discover that the pro traders are on the buy side, they'll shift there and gap it up. And that happens a lot these days. Understanding order flow. I don't think anyone ever talks to you about order flow, and it's absolutely critical because you're part of order flow. High-frequency trading firms use formulas to find anomalies in order flow. This is a normal order flow where everybody is independently deciding what price they want to pay for a certain stock at any given time during the day. When cluster orders are identified by the quantitative analysis AI formula, it triggers automated electronic orders that can cause whipsaw action or extreme patterns. All high-frequency trading is done via a computer-generated order using AI. There are no humans trading at these computers. The computer is programmed, and HFTs have been around since 2002, so it's nothing new. It's been approved by the SEC. Why would the SEC approve high-frequency trading? Well, they used to be called So's Bandits. And they were rogue floor traders who were used to work on the floor of the New York Stock Exchange. And they all decided when the computers came out, boy, we could just work from home and we wouldn't have to put up with all the mandatory uh, profits that we have to make every day and the stress of the floor trading. So they all started trading. And they knew the markets because they were floor traders. So they were starting, they would trade against their own market makers. And the market makers got really bad. Then when we went to decimals, it became extreme. And the decimals came in 2002 because the banks were not making any money. They were losing money and they were very frustrated. So they went to the Congress legislator and said, "Oh, the average trader can't figure out, retail trader can't figure out fractions. It's so hard for them. You should shift to decimals." And the the legislative people, senators and Congress people said, "Oh, that makes sense because I sure can't figure it out. So yeah, we'll just make everything decimals and we'll make the market efficient." Well, they made it too efficient. Okay. So in order for the Soos Bandits to make any money, they had to program it into a system that was hooked into the exchanges so that they could be a high frequency trading millisecond transaction. That's how it all happened. SEC approved it because the exchanges went to the SEC and said, "You took the dark pools off of the exchanges. That's where all the liquidity is. We have no liquidity." And the SEC says, "Well, HFTs can create the liquidity." And so HFTs are maker takers. They make liquidity and they take liquidity, and they are approved. And that's why they're there, to make liquidity or remove liquidity. So that if there's no orders, there's a void of buyers, they fill the order flow before the market opens with sell orders to sell it down. They provide the liquidity that you depend upon. Okay? This can cause major price trend disruptions, mostly intraday. Retail day trading has become much harder because of this. 99%, the SEC is saying 97 to 99% of everybody who starts to day trade loses money. So be careful if you want to do that. It's a bad idea. It's a lot easier to trade styles like swing trading, velocity trading, momentum trading styles, platform position trading styles, intermediate trend if you want a longer hold. You don't have time because you're working every day. What is market condition? Market condition is the cycle of the bull market or bear market. The cycle of the bull market is many times longer than the bear market. How long does the average bear market last? Anybody? Anybody have a clue? It's shrinking, 1.2 years average. Yeah, 1.2 years. Not very long. How long can a bull market last? Well, it depends on whether it's a minor bull market, like after the 1980s flash crash of the market because of the banking debacle system. It was a slow minor market because we didn't have any new technology. Then comes along cloud technology and it goes to a moderately trending market condition. So it's a moderate market condition and we're moving up slowly. It's a bull market. There's a moderate bull market. And it's moving up because it has cloud technology, but that's not enough to drive it into a great bull. We are in a great bull market. We have 20 new technologies. AI is just the beginning. Robots and robotics are coming. The bull market of which started in 1987 and ended in 2000. So 1987 to 2000 was the longest bull market on history. This one is probably going to be longer. It's not predicting. Who cares about predicting? If you predict, it's going to go in the other direction. It's just predictions are worthless. Projections, forecasting, just common sense and understanding cycles. The bottoming market, who controls it? Dark pools. They build every single bottom. If without them, the bottom doesn't get built. Platform, who controls this? This is the market when everybody's scared and you have platforms moving up and little bits of runs. Everybody's scared to death of the market. Oh, it's failing, it's failing. Oh, we're going to be in a bear market. Ah! And the dark pools go, well, bargain hunt. We can find all kinds of stocks that are in good positions for bargain hunting. Moderately trending up or down. Now you're switching to professional traders taking control of the market, control of the price action. It can be up or down. In a bull market, it's up. In the bear market, it's down. Moderately trending. Pro traders are in the mix. Small funds managers start to get a little bit braver. So it's moderately uptrending. So the dark pools allow the pro traders to take control, and they just sit there and they let their stocks rise in value, and the return on investment for their clients is going up and up and up, and they're happy campers because they're making money. Velocity up or down? Who creates a velocity market? You do. Retail traders, retail investors, small funds managers, all hyped up or all in panic. You don't go in front of a mirror and say, "Oh, I'm going to be calm today. Oh, I'm going to control my emotions." Learn the market, and you don't have to worry about your emotions. They disappear. Topping market condition is started by the rounding. The peaks and valleys aren't so common. I haven't seen a head and shoulders in years. So the topping actions have changed, and that's the buy side institution slowly rotating to lower inventory to get money into a new, stronger company that's going to have growth in the next few years. So but the topping market is controlled by the sell side institutions, hedge funds, HFTs, and pro traders selling short. Trading range markets don't occur very often. The last time we had a trading range market for the indexes was way back in the 70s when this NASDAQ just first started coming online. And it was just a wild, crazy time with a lot of problems. But trading ranges for individual companies are common, and you will see it on the charts. Mostly if you will have to go to a weekly chart to see what's going on. And they are very hard to trade. Just don't trade them. There's plenty to trade. So these are my market condition analysis scans. I have created these years ago when Howard and I had a floor. And I wanted my traders to do well. And I was studying the futures and all this stuff because I was really young. And I was like, wait a minute. The market started down, now it's moving up. I need to create something that tells me what it's going to do so my traders know that today, even though it starts down, it's going to reverse. So I asked the market to give me all the stocks that moved up with momentum at the end of the day. This analysis occurs about 2 or 3 hours after the market closes because I want all the dark pool orders, which are delayed during the day, to go into the national clearinghouses so they're dumped into my software. Okay? So all the stocks that moved with momentum today, and how much did they move, and what companies what industries were they in? Then I compare it to all the momentum that went to the downside. How big is the downside compared to the buy side? What's the relationship? What stocks were being sold heavily in what industries? And so I have all this information. Look at all this information I got. It's really cool. I can determine the bias for tomorrow at 6 or 7 o'clock at night. Then I ask, okay, where are the buy side institutions? What companies are they buying? Oh, biotechnology. Woo. So it gives you a lot of information, and I define it in a report every morning for my students what the buy side is doing. Then I ask for all the stocks that are in consolidations and what are they doing, and I ask for all the stocks. Oh no, I asked for the stock. This is bottoming. Of all the stocks that are in bottoms, we have a little bit of shortage of bottoms because so many of them are now starting to move out of the bottom. So now it shifts over to the buy side institutional accumulation chart. So there's fewer here and more here. Then I asked for all the stocks that are in consolidations, and we can see that they're all negative right now. Banks, regional, little selling off of regional banks. And I was like, So this is not a lot of percentage change. So these are minimal. So that's dark pools kind of letting go of some of that. Then we have the turning at a trading range high. How many stocks are turning at a high? So I can see how many stocks are moving and trending down. When this is super high and this is super high, it occurs before the market moves down. So I can tell my students that we have, my professionals, we have the risk of the market turning down the next day, even if the stock market gaps up at open. Then I ask for a comparative. It's usually about a month. I say, compare the price today versus so many days back, because I want to know if price is improving over time. That also tells me where the dark pools are. So I have this vast information that I summarize for my students every morning that gives them all kinds of information. So market condition analysis is which of the market participant groups are in control of price. Buy-side institutions, pro traders, sell-side institutions, corporations, retail. Small funds, what technical patterns are prevalent and reliable? So you only need to look for those patterns. They need to be reliable and they need to be prevalent. How price will behave at resistance and support, it varies. If you have a velocity market, it's going to blast through resistance faster than a moderately uptrending market. What trading styles work best for that particular market? Trading styles. You apply strategies to your trading style. Day trading is not a strategy, it's a style. Which indicators to use and how to incorporate new indicators, such as what the ones I'm using. If you love a certain indicator and it works for you, keep it. But if it's not working for you and you're frustrated, don't blame the market makers. They're just doing their job. The inherent risk in trading specific styles. There is risk in market conditions give you more difficult risk factors. So if a market shifts from a moderately platforming market to a swing velocity market, your platform position trades are going to switch to swing trading. You have the choice of turning it into a swing trade and selling, or just going ahead and selling. Most of my students just use platform position trading and swing trading both, and so they just switch to swing trading. What trend line patterns are common? Yes, you know uptrends, downtrends, neutral trends, sideways trends. Trend line patterns is what you haven't learned yet. Which entry and exit signals are most reliable? There is pole vaults, there are springboards, there are nudges, there are nesting candles, there are resting day candles. All of these tell you different things. A resting day candle is pro traders just taking a little bit of profit or raising their stop slightly. A push candle, it tells us that there's momentum behind that that's going to accelerate the next day. All these candles are new to the ones that you have learned because our markets have changed. The strength of the price and volume patterns. Volume is critical. You have to have price, time, and quantity in all your analysis. The TechniTrader difference. We are a professional level education, but don't let that scare you. Relational analysis, hyper leading indicators, and so on. I teach a lot of beginners that do extremely well. Why? Because they follow the rules and I don't have to untangle them again from their bad habits. A professional style trading journal I created, which provides written evidence of your activity trading as a business, because a lot of you should be considering trading as a business. You may be thinking about going into a business. Trading as a business is one. And also historical data to consider and compare over time. And yes, you can use, you can bundle 5 different months worth of analysis together and have a co-pilot do an analysis for you. Your personal trade management planner. This was created by Howard Johnson. It provides a monthly plan for your monthly trading goals. It tells you, you plug in some numbers. It tells you the number of trades based on the capital that you have that you can trade. It tells you the stock price range you should be trading within. It does a risk assessment and what you should be doing as far as risk management, risk control, mitigating risk. Risk is the big thing that you never think about. You just say, oh, I think the stock is going to go up, so I'm going to buy it. Profit potential. The profit potential is critical. Profit potential versus risk is an essential part of the analysis and overall process. And all my students that are new go, Martha, the trade management planner says I don't have to trade as much as I think I do. I said, less is more in the market, because what you're going for are the top level, best of the best trades that you can have to make lots of money. Trading all the time just loses money. Trade calculators and other tools that streamline accuracy and execution. These are Howard's trading calculators that he used in his very, very dynamic scans, sorts, layouts, and parameters are mine for your trading style and market condition, and they are somewhat, we modify them or you can modify them for your trading style. Trade simulator must be a real-time simulator. This is not a game. The stock market isn't the game. It's the business of the businesses. It's what drives our economy. It's what pushes us forward. It makes it possible for you to retire. Use a trading simulator that is a real simulator. Market condition analysis scans, which are provided with your course based on what course you choose. Controlled bracketed orders designed to eliminate poor fills and other things. So Howard Johnson wrote this controlled bracketed order for our floor. Then years went by and he wanted me to teach in my retirement. I said, are you crazy? But he talked me into it anyway. So here he is designing the course, and I'm come back from my skating because I did swing trading. So I just went, had a good time, came back and saw all my profits. Control bracketed order. Howard talked to a market maker. He got a New York Stock Exchange market maker. I come in and I'm going, who are you talking to? Oh, Herzog, the market maker. And it's like, my jaw is trying to fall into the floor because nobody talks to New York Stock Exchange market makers, not in those days, not even now. And he says, yeah, yeah. And so when he hangs up, he says, oh, he really liked my controlled bracketed order. And guess what? He wants to use it on his floor. He thought it was so fantastic. So, and I'm going, of course you told him he could do that. It's still being used today because it was brilliant. And Howard designed this. And that's what you teach here. And we're the only ones that teach it. Morning market open reports, I've talked about those before. They help you with your studies. Daily Market Educator, which gives information. You get a month with that when you start the course. Discussion groups and commodity communities within the TechnoTrader. Students only campus online, which is closed. So you can't have anything get out there to the HFTs. So you do have access to a community of professionals, semi-professionals, trading as a business people and all things that you can listen and learn to. Tutoring and coaching for new students and answers to all your questions, plus student mentoring sessions every other month. So those are awesome too. So learn to trade stocks. I invite you to visit TimingResearch.com to learn more. Learn to trade stocks with a professional process for swing and position trading, which I recommend. Your roadmap to trading as a business with a low risk methodology. All of you should consider this because you're going to save huge amounts. Right now, if you trade, you have to fill out a Schedule D and itemize every single stock and all this stuff, and it's just a nightmare, and it's getting more expensive. The taxes have gone up with that. So when you're on our website, you can register to watch one of these mini courses. It's an actual mini course. And it gives you an idea of how we trade, what we're teaching, how we present the information. Howard and I both had educational backgrounds, which is a bonus because I know how to educate. We know how to educate. And we also were experts in the stock market. So if you're a brand new beginner and you have less than 1 year, start here. If you have more than 1 year or up to 5 or so years, start here. This will be the trading plan I just talked about, professional trading plan. It'll blow your mind. This will give you the introductions. If you get brave and you want to learn more, you could always try this one. Once you've registered, you can watch any of them. A relational technical analysis. This is a 7-day preview of our course. You actually get to start the course for free to see if it works for you. And if it doesn't work for you, that's fine. But some of you, this is going to be something that's going to change your life. I have lots of students that tell me I've changed their lives. These are things that come into me without me asking. And I really should have taken this course 10 years ago. I hear this all the time. Results have shown it's a bargain. I paid for the course on my first trade. This is really common. Changed my family's lives because he put together all kinds of things that his families and his children and grandchildren and so on and so forth to come after will be taken care of. What a legacy! Gains exceeded cost beyond what I was expecting and so on. I have 50 pages of this stuff, guys. We've been in business 27 years and everybody loves us. So here is your 24 hours to claim gift, free 1 hour training video, 7 days access. Sign up here. If David can put that into the little area chat group, then you can get that. https://ttrader.com, and you can use your smartphone to touch and get that right from there. This is precision entry and exit signals. It's awesome, and you're going to learn a lot. So is there any questions before I end this? No questions? Hello, David. Are you there?
Yeah, I'm here.
Okay. Was there any major questions before I let you go? Because I know you have the next speaker to come up.
Um, let's see. I'm not seeing any questions so far. So if anyone has any questions, go ahead and type them in. You have about another 10 minutes if you have anything else you want to
Okay, yeah, I
cover.
guess I'm reading my clock wrong. Sorry. So I want you to think about raising your expectations. I want you to think about everything you have learned is useful. You haven't learned something that isn't useful other than bad habits, and we can get rid of those. Everybody says, well, the psychology of confidence is the psychology of trading. You can't talk yourself into this. The only way that you will build confidence in your trading is consistently making successful trades. Money is a big, huge part of our society. It defines whether you are considered successful or not. When you're losing money, it's as painful as losing a family member. It's agony. And it is hard to overcome, and that's what causes the uncertainty. That's what causes you to hesitate. That's what causes you to be unsure of what is going to happen. And so then you hesitate, or you gamble, or you risk. When you have the trade management planner and the trade calculator and everything, it takes all of the math problems away and the guesswork. If it tells you that you're trading your price range that you should be trading at based on your risk tolerance and your risk management, then you should be trading at the 20 to 30 or 50 or 100 to $180 price range. Don't trade a $3,000 stock if your confidence isn't there. Confidence doesn't come from telling yourself to be confident. Confidence comes from knowing that you have enough money to take care of yourself and your family and whomever you care about, and you don't have to worry about it at all. Billionaires don't worry about things. Millionaires don't worry about things because they have enough money to take care of anything that comes up. So they're not worried. They don't care whether the market crashes or not because it's not going to affect them majorly if they can control things and manage things. So you need to also consider not speculating so much because speculation is a gamble. The market is stock market is the business of businesses. It is not a casino. There's no one guy and then other people trading against it. It isn't a card game. It isn't roulette. It isn't. There are things in the charts that will always tell you what is happening. You just need to learn how to read the charts with spatial pattern recognition skills. It's a language. The candlesticks are a language. The indicators are a language. That's why if somebody's been trying to use AI to select stocks for them, it fails because the AI can't understand the language of candlesticks. It can't understand the language of indicators. And what AI does is it just goes around and searches for some sort of chat room group that's open or social media, sees they're trading it and suggests that stock for you. That's what it does. Red light, green light doesn't work. They put AI against red light, green light, and going, it didn't work in the 90s, so how's it going to work now? Red buy, red sell, greens buy, red sell. It doesn't work. This market is too hysterical. It's got too much going on that's just crazy, crazy activities that are happening. And so you have to understand the dynamics and always look for the bottoming markets and say, oh, dark pools are in here. Dark pools are causing this activity to occur. So you might want to let's go, and since I've got a couple more minutes and nobody asking me to see anything. No, we got the market right now, and we can see that it's just holding right there. If we look at these stocks, so what's happening here? We had this sideways market, ran down, little V shape, and it's moving up. Who's buying? Buy-side institutions. So you have to really take a look. So would you buy this stock? Oh, it's going up. Everybody's recommending it. No, because you can see the pro traders are selling out of this stock. They're selling out of it. And there's some smaller funds buying the stock, but it's topping. It's topping. This stock is in a big, long bottom formation. The bottom formation isn't complete yet. It has a resistance level here that it has to go overcome. And just because it gapped up one day, it's coming back down. So you got to be careful about that because Bottom completion is crucial for platform position and swing trading. You can do some swing trading down here, but you can also do it when it starts to take off. But you have to wait for that bottom to complete. You can't just have it hanging there and not doing anything because it will retrace. So there's tons of information that's in the charts, and you need to start paying attention to the charts and learning how to read the charts at a higher level. Raise your expectations. $200 a day doesn't even pay for the electricity and the computer repairs on your computer. It doesn't. It doesn't. Okay, that's me. Any questions?